Thank you, Kevin. Thanks to Marine Money. Good afternoon, everyone. It's a pleasure to be here in Dubai at the Gulf Ship Finance Forum. This region is rapidly emerging as a critical hub for maritime investment. It's exciting to be part of a conversation that connects capital to opportunity in such a dynamic market. Today, I want to talk about two financing tools that are reshaping how owners and operators raise capital. Direct lending and Nordic bonds, or the bond market more generally. Both have distinct strengths, and when used strategically, they can offer flexible, scalable financing solutions that complement traditional bank lending. Back in the 1980s, Gordon Gekko famously declared that greed is good. In these volatile times, I'd say in ship finance, I'd argue it's less about greed and more about flexibility. Flexibility is good. Whether it's direct lending, stepping into gaps left by banks that have, to a degree, retreated, or the bond market, offering tailored structures for growth, the real value today lies in having options and understanding how to use them strategically. So, what slides? Very briefly, Clarksons, I'm sure it's a familiar name to many of you. My name is Turner Holm. I'm a managing director in the investment banking arm of Clarksons. We're part of a larger group. I'll save the time. We'll go through this. But I would say one thing about Clarksons, as opposed to many other investment banks, which tend to be, let's call it regional, we are very much a global investment bank. We focus on core sectors rather than core geographies. So when we raise money, it tends to be from a global group of investors. So hopping through that, I think I just want to start the discussion with something that everyone intuitively knows, but it's good to just back up and think about it for a second, and that's that shipping requires debt. There's just no way around it. So here I've just tried to illustrate that very simply by showing you a typical ship finance project, right? The details don't necessarily matter in terms of all the assumptions here. This is really just for illustrative purposes. But in shipping, value arrives slowly, and debt brings it forward, right? So shipping is very capital intensive, and equity is scarce, in these days extremely scarce, and it's expensive, in these days extremely expensive, and so debt is the key financial weapon that owners have. So to just illustrate this very briefly, why do we need debt? Okay, well, equity is impatient, yeah? That means that they need rapid paybacks. But ships have long lives, and paybacks don't usually come rapidly. Obviously, you can time the market perfectly and get it back quickly, but usually, as a matter of sort of principle, it doesn't come back quickly. So just show you a simple ship finance project, you see that, in a 25-year life of a ship, a new build in this case, or a resale, whatever you want to call it, you get about half of the net present value, about half of the value of the ship in the first 5 years, right? And then you get the other half after that, right? Equity in shipping is scarce and expensive. It doesn't like to get paid back over 25 years. It likes to get paid back very quickly. Why? Because shipping is volatile. And what is volatility? It's risk, right? So they want to get their money back very quickly. So in shipping, the question is not, do I need debt? Rather, it is, how much and what kind of debt do I need? That's the question. So today we're going to talk about two different sources of that debt that you may not be aware of or may not be familiar with. So first of all, let's just look at what is typically the cheapest and the core source of debt for the industry, and that's shipping banks, right? That's ship loans from banks, right? The issue, as we all know, is that that's become more difficult in recent years. A lot of the traditional lenders have maybe not fully backed off, but they have backed off, and the numbers don't lie, right? So if you look at the top 40 shipping banks, since 2011, $150 billion have come out of their books and off the balance sheets of ship owners. It's a pretty big number, $150 billion. Shipping is a big industry, but $150 billion is a real number. It's a 37% reduction in shipping loans. Now, it's stabilized in the last few years, so that trend has slowed, but nonetheless, it's a reality that banks have, to a degree, retreated from the industry. And I'd say from offshore perspective, it's probably even more than traditional shipping. Yeah, why? Well, regulatory demands, that's one of them. Basel III. These loans are considered risky. They have to set aside more capital. It's a lower return for them. There's obviously been cyclicality, downturns. Some banks have taken losses. They've been scared away. We've had ESG, which has not always been helpful for offshore. And there's been more and more focus on key clients. So if you're not one of those key clients, then that can be a difficult situation to be in. Stepping in to fill this gap are what we call direct lenders, private credit funds. Yeah, there's some of them in the audience today. There's some of them on the panel after me. So this is a new type of lender, right? This is not a bank in the traditional sense. This is a fund. It's an investor, but it invests in loans rather than shares. So this market is really just arriving in the Middle East. There are a few players here who have done these direct lending deals, but it is a new tool in this region. Yeah, and I thought that's why we should talk about it today. This started in the US 10, 15 years ago. If you look at the size of this, it's just enormous. So there's 10 years ago, there were $500 billion in assets under management for these private credit funds, direct lenders. In the last 10 years, that has tripled, now to $1.6 trillion. So it's grown incredibly rapidly. And if you look at the estimates out there, in this case from Moody's, it's going to double again over the course of the next 4 or 5 years. So this is becoming an extremely important and strategic source of financing for shipping and offshore. And so I think it's important to keep that in mind. So why? There's dry powder. There's a lot of funds that have to be deployed. There's attractive yields. Shipping also has secured assets. They like this. And these funds have a lot of structuring capabilities. Briefly on the Nordic bond market. Let's see here. So called Nordic, it's not just for Scandinavian companies. It's really, truly a global market. It is in all currencies. And this is a place where you have actually a very strategic source of capital for offshore and for shipping companies, whether they be based in Europe, US, Asia, Middle East, doesn't matter. It's really just a process. It's just a market. Yeah, and I think if you look, it's there are now 84 issuers of shipping and offshore debt, coming $11 billion of traded debt here. So this is a strategic source of capital, and we'll have a provider, or excuse me, we'll have a corporate issuer on the panel shortly. So we'll talk about that. Yeah. So when people think about the bond market, I think a lot of people think that it's for giant corporations in America, Dow companies, but it's not, right? And the reason that the Nordic bond market works very well for shipping and offshore companies is not only do you have a very knowledgeable investor base around shipping and offshore, it's much cheaper, right? So you can do smaller issues, right? So like you'll look at bonds of say $1 billion in many cases or more in the U.S. But in the Nordic bond market, we do bonds as small as $50 million, and that's because the costs are 80% lower. Yeah, unfortunately for the New York lawyers. So again, I started with flexibility is key, right? It's flexibility is good. It's about having options in a time of volatility, right? So these two sources of financing that I mentioned, they have their strengths, they have their weaknesses, but again, this is about presenting options. So bank debt, you all know about that. It's usually the lowest cost, right? Which is great, but the LTVs you're getting in, the loan to value, the loan versus the collateral value of the ship, right? It's pretty conservative, and so are the repayment profiles, right? So it's cheap, but it comes with its drawbacks, and not everyone can get it, right? Because shipping banks have become extremely focused on specific relationships. Whereas these other sources, they tend to be a little bit more expensive. It depends on the issuer, but you can get loan to value. You can get a much larger loan on the same ship, right? And when you're trying to deploy equity across a large fleet, that can be very helpful. And in addition, you tend to have amortization repayment profiles that are slower, and that can increase your returns as a ship owner. So it's all about options, and these are options that I think are more and more relevant for Gulf ship owners and Middle East issuers. So with that, I'd say thank you. And now that we've talked about this in theory a little bit, let's look at it in practice. And we're going to turn to two issuers who have done that. Was it right on time? And so, sure.